What that all that free money did was, in my opinion, it created an enormous bubble. We call it the everything bubble. It's at the sovereign currency level. That's what makes it different than the housing bubble, which was 2008, or the dot-com bubble, which was 2000. And that bubble's in the process of coming unwound, and bursting and coming unwound. And it certainly did that in 2022. The stock market's down 20-30%. Bonds got smashed. I mean, a rare year. Had been a long time since we had a year like that in both of those. But of course, everyone bought the dip and thought that we're going to go back to the old conditions, and interest rates will, inflation will come back down, and this was all just a COVID problem, and interest rates will come down, and everything will be good again. So you got to buy stocks. And I think those people are going to be sadly wrong and disappointed with the outcome. I think the stock market has a lot further to fall in the next couple of years.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Lawrence Lepard, who's the partner of partner at Equity Management Associates and a sound money advocate. So, Lawrence, thanks so much for coming on the podcast again.
Oh, enjoy it. Always enjoy talking to you, Anthony. Nice to be back.
Yeah, thanks again. And we just mentioning before how much is going on in the world, so I'm sure we'll have lots to speak about.
We will.
So I'm going to be really annoying, and my first question is just going to be, what are you currently seeing going on in the markets and
Sure.
Yeah.
Well, yeah. Let's see, kind of big picture. Well, I don't know where to start. So, we're in that period where I think the Fed is pretty close to, well, the Fed, in my opinion, the Fed is done raising rates. The market is telling us that. The Fed speakers are telling us that. The futures market on Fed rates are telling us that. I think we're in that period where they're pretending they've got inflation under control. I don't believe they do, but they're pretending they do. It's certainly come off the boil that it was on a year ago. And they're, preparing to print more money because that's what they do, and that's what they have to do to keep the system going. There are a lot of different cross currents. I mean, the 10-year bond went up as high as 5%, and then I think now people are starting to price in maybe a little bit of recession risk. I mean, probably the most amazing outlier in the U.S. markets right now to me is the U.S. stock market, that it's all kind of hung together. And I suspect that's just because people have been trained to buy the dip, and they believe that the Fed has got their back in terms of dropping rates and monetary accommodation in the future. However, I don't think it's going to work the way it has in the past. I think this time, when they start dropping rates, very much like in 2008 and 2002, or 2001, things are going to get much worse in the economy. I mean, what they've done, the increase in interest rates from 25 basis points to 5.25 was really enormous, and a shock to a system that was built on ZIRP, zero interest rate policy, from 2008 really to present, with a few gaps. I mean, they went to 2016 and they started hiking, and then they had a pivot, based on the repo crisis, and then of course they had COVID and they went crazy. And so what all that free money did was, in my opinion, it created an enormous bubble. We call it the everything bubble. It's at the sovereign currency level. That's what makes it different than the housing bubble, which was 2008, or the dot-com bubble, which was 2000. And that bubble's in the process of coming unwound, and bursting and coming unwound. And it certainly did that in 2022. The stock market's down 20-30%. Bonds got smashed. I mean, a rare year. Had been a long time since we had a year like that in both of those. But of course, everyone bought the dip and thought that we're going to go back to the old conditions, and interest rates will, inflation will come back down, and this was all just a COVID problem, and interest rates will come down, and everything will be good again. So you got to buy stocks. And I think those people are going to be sadly wrong and disappointed with the outcome. I think the stock market has a lot further to fall in the next couple of years. So, it's what I've described as the Fed clown car bouncing off of the guardrails of deflation and inflation. Of course, the inflation seemed impossible in 2020 or 2019, and they said, they were saying, their Fed speakers saying inflation was too low, and then when they had a little inflation, they said it was transitory. Of course, as we know, when it broke out, it went crazy, and we had enormous inflation. Headline inflation 9%, but in reality, much higher. Of course, then way too late, they slammed on the brakes and took the money supply, which had grown 2 years in a row, or grown cumulatively 42% in the COVID period. They slammed it hard, and now it's down slightly. And bank credit and all the sources of money have kind of dried up. And so, we've had a meaningful tightening in monetary conditions, which they've tried to do in order to control inflation. The problem with that is that the higher interest rates hurt debtors, and the biggest debtor in the world is the United States government. And so, the U.S. government with 30 some odd trillion, 34 or 5 trillion, and coming up on that of debt is, now being forced to pay interest costs of close to $1 trillion a year, which was up substantially from 3-4 years ago. It was closer to 300-400. And that blows out the deficit, which then means they have to sell more debt, which means, all things being equal, more debt sold into a market, supply demand, interest rates will go higher, which then of course increase interest costs. And you can see how, guys like James Lavish and myself have described this as a doom loop. And so they really can't get out of it unless they do yield curve control or a reset of the currency or something pretty radical, or balance the budget. I mean, that's actually what they should do. But if you watch and follow the U.S. political scene carefully, as we do, that seems to be pretty unlikely in current conditions, current circumstances. So that was kind of long-winded, but you asked for the big picture, so I thought I'd give it to you.
No, thanks. I don't think it's long-winded. I think it's in depth, which is what we need more of, rather than these bite analysis. But if we go to you mentioned there that you think obviously the Fed have raised rates too high. That's not going to just going to be the cause, but we are going to enter into the doom loop. Are you not thinking that inflation has come down higher than expected? Growth is still quite high. So do you think is there a possibility that they've maybe somehow landed the plane and we're actually in a Goldilocks
Yeah, the whole
scenario?
soft landing thesis. I mean, it's entirely possible. I think that they will keep the economy going. I mean, I think the economy's in a lot of trouble. I think these interest rates are going to hurt more than people realize. I think that there's a lot of trouble in commercial real estate land. There's going to be a lot of trouble in residential real estate land, because nobody can really afford a house anymore, because mortgages that used to be 3% are now 30 or 8%, 7.5, I guess. I actually favor the hard landing thesis on the economy, but it's entirely possible that I'm wrong, that they managed to kind of land the plane, and the economy keeps bumping along. But the only way they'll do that is if they start chopping rates, they start letting credit and money supply growth grow, because they have to, and they can't deal with these high interest rates. They just can't. The high interest rates are strangling the economy. But if they do those two things, yes, then maybe the economy is healthy. But the counterbalance to that is then inflation is going to come back, right? So yeah, I mean, and that's, by the way, that's probably what I think they're going to aim to do. Whether they'll pull it off or not, I don't know. Nobody does. But the politicians, I think, deal with what's the loudest or the biggest apparent problem at the time that they're focusing on things. And of course, 2 years ago, with inflation printing at 9%, that was a big problem. And they had to do what they did. I mean, they absolutely had to. They'd lose all credibility. And so they did it. As you can see now, what they're doing is, we've had a bunch of Fed speakers saying, well, it looks like the market's done its job for us. This morning, the Wall Street Journal had an article, I retweeted it. They kind of said, well, inflation is now under control. Things are better. So they're setting up the narrative for, okay, we can start dropping rates. We can start doing QE again. We can stop the QT. Maybe ultimately they'll have to go to yield curve control. I mean, we don't know how all these variables will play out. We don't know what'll happen to the price of oil, et cetera. But I do know that politicians try to keep themselves alive and keep themselves in office and keep the economy going. And I think faced with if you had the two easy choices, or the two clear choices of keep money tight to fight inflation, but the economy is going to tank, or pretend inflation is solved and go back to looser money to try and keep the economy from tanking and keep unemployment low and keep things going, and the consequence being you're going to have to suffer some inflation. I think the politicians will pick the second choice every time. So I think we have another inflationary wave coming. Once the Fed, once it becomes clearer and the Fed starts going in the other direction on interest rates.
Okay. Do you think it could be maybe more of a monetary inflation rather than a maybe high street inflation? So if we look at what happened during COVID, it was lots of supply chain issues that had a big impact.
Yeah.
Obviously, there was, yeah. So do you think
Yeah,
that's possible?
it could be financial asset driven. I mean, that's certainly kind of what the stock market is telling us. The stock market hanging in there is saying, we think the free money is coming back, and And it's most people, I think, view the stock market as probably the best place to invest today. I don't, but I think a lot of people do. So yeah, I could go there. I mean, that would certainly make it rhyme a little bit more with the inflation that we saw from 08 to 14, 15, 16. Where you didn't have that much printed headline inflation in things that people bought, but you had a lot of inflation in financial assets. Having said that, though, I think the wild card here is that, at a bigger picture level, and this is important, I think, for people to understand, we had 40 years of deflation from the Volcker, tightening in 1980 all the way through to 2020. And in my opinion, March 2020 we hit peak deflation. I mean, as you'll recall, we had negative interest rates in lots of European debt securities. So, I mean, you just couldn't get any more deflationary low interest rate environment than we had there. I think the 10-year at one point was trading 50, 60, 70 basis points. It was insane, right? That changed, right? COVID came along, all the policies changed, the money got printed, that changed. And history shows that when inflation gets out of the box, it's hard to put it back in. And so I believe that we have now entered a deflationary environment. Also, during that 40-year period, we overinvested in financial assets. I mean, everyone bought the FANGs and the Magnificent Seven and, stocks and, everything that was financially driven. And there was really very little capital being spent on oil or oil and gas exploration or gold or silver or even, wheat or meat, cattle. I mean, commodity investment has been depressed for a long, long time. And now that we've broken out of those downturns and now that those prices have started to go up, it's going to take some time because you can't just add capacity in commodities by turning a switch. You have to actually invest capital, and it takes time to bring the supply online. And by the way, now the investment capital is more expensive, and it's happening everywhere. I mean, this morning I saw a chart of orange juice. I mean, I don't drink orange juice; it's too sweet, but things up like 200% in the last 6 months. I mean, it's just every single commodity had been beaten down in the deflationary world, and every single commodity appears to be trending up now. Admittedly, back and forth, but trending up. And oil being probably the most important commodity that we all use, live on, etc. Hasn't, it's come down a bit, but it's coming down now just because it appears there's some softness in the economy, but it hasn't really corrected. I mean, we've now kind of established a higher level for all of these commodities. I fully expect oil to go to 100, 150, $200 a barrel in the next 5 years. I mean, the shale oil fields in the United States have peaked, according to Rosenzweig and Goring and Luke Roman and others. So, the marginal barrel of oil is, it's not there at these prices. We need higher prices to bring it out, and that's kind of true across all commodities. So I think we're in a world where we're going to see commodity-driven inflation, and it's actually kind of a worst of all worlds. I've said in the past that I think what's going to happen is you're going to get deflation in the shit you own. Like, your house might go down in value and assets might, stocks might go down in value. Bonds are certainly going to go down in value because they're not paying you enough for the risk you're taking. But you might get inflation, the stuff you need to live, gasoline and food. And so it's kind of a biflationary environment. Another way of saying it, I think, is, and it reminds me of this too, because I was a teenager at the time, but it reminds me a lot of the 70s. The decade of the 70s was a very inflationary decade. And the two best categories to invest in that decade were gold mining stocks, and oil and gas stocks. So, my view is, and I think a lot of investors have missed this. I think the deviant perception here is that we're going back to the old world. I mean, you get on Bloomberg and you Google or you look up what they call the inflation swap. So 5 years out, what do people think the rate of inflation is going to be? It's still at 2.6%. So that tells you that investors are willing to bet that in 5 years we'll be back to 2.6% inflation. I don't think there's a chance of that. I think there's no way. I think we are in an inflationary environment, and the investment world is going to have to deal with that in the next 4 or 5 years. But it has really big implications for where you want to put your money, right?
There's some really good points, and as you said, there's not only that commodity drive, there's these other secular shifts, so geopolitical shifts.
Well, there's that too. I mean, obviously, war is generally speaking a very inflationary thing, right? And yeah, I mean, imagine if all these idiots managed to get us into some really big shooting war or piss off Iran enough to close the Strait of Hormuz, and the price of oil triples. I mean, there's some tail event really bad outcomes. I'm not even factoring in those. I think even assuming the world stays pretty peaceful, and we kind of muddle through. I still think we live in an inflationary world now for a while. I mean, until we address a lot of these issues.
Yeah, and I guess what normally happens in those sort of trends is that there's massive, as the prices go up to a point where it's, you know, it's too high, there's this massive investment. These companies make a lot of money, and then it almost flips the other way. So sort of what we
That's
saw
exactly
after,
right.
yeah.
No. This won't last forever. There's no doubt. I mean, look, I mean, if you take the oil price of oil to 150, we're going to be drilling all over the place. We're going to find a shitload more oil. I mean, I mean, the nice thing about the commodities markets is when the prices go high enough, the supply gets, funded, and we will find the supply, and then of course, that's the boom, and then of course after that you have the bust, where you got too much supply and the price can't be justified, and it goes down the other side of the cycle. But if you assume that, I mean, typically these commodity cycles can last 10, 15, 20 years. It depends on the cycle and so forth. And if you look at that, I mean, I haven't seen a commodity cycle that lasts 2 years, right? And so if you kind of, or 3 years, so if you kind of assume this one started in March of 2020, right, where we were, at a low point on a deflationary scale, we're only 3 years into it. I mean, it's a little longer. Gold bottomed in 2016, so that one we're a little bit longer into. But the point is that I don't think we've really seen serious commodity inflation, most commodities, since the early 2020 area. And as a result of that, I think we got some time to run on this particular trend.
That's interesting. And as you said, since then it's been quite ups and downs. So it's not going to be all straight up, but there's
Well,
still
that's
these
right.
very
There's
significant.
zigzags which confuse people, right? I mean, I get it. I mean, right, stock investors right now are thinking, hey, this is great. We just printed 3% inflation. It used to be 9. God, that's great. It's going the right way. We're all, it's all good. And I understand that thought pattern. And I mean, and I understand how they say, okay, well, if it went from 9 to 3, it's going to go from 3 to 2. We're going to be, we're done. We're good. My view is just that I don't think that's how it works. I think the other factors I described are going to arrest it, and I think part of why it went that far is, I mean, well, there are a lot of reasons. One, the numbers are cooked. I mean, let's face it, we're not even dealing with real numbers. I mean, if you go to the Chapwood Index, if you go to shadow government statistics, I'm sure many people saw that in this last inflation report, they reclassified some healthcare expenses, and they said that healthcare went down 34%, which of course nobody's healthcare went down 34%. In the last year. So, the numbers are kind of cooked, but even with the cooked numbers, you can kind of see the trends and kind of get a picture of what's going on.
Yeah, no, great point. So if we go back to sort of, I guess, the bond market, so you don't
Yeah.
think this recent move is is shifting? You think that we're going to see higher for longer yields?
No,
And
I mean, look, unless we go into an outright depression and collapse, and that's one of the cases that could happen. I mean, remember the bubble that occurred here in stocks in December of 2021, the stocks were on fire. Everything was on fire. I thought we were having a crack up boom. Crypto was going, everything was just blazing hot. And it's 1929 like. And typically when you have bubbles of that magnitude, they fall 80%. I'm not suggesting this one will, but it could. And if we had that kind of thing going on, I mean, I've seen some credible technical guys saying they think the bonds are going down to 2% because they think we're going to literally enter a complete outright deflation. And that is one of the possible cases. And, I don't think it's a likely case, but it's a possible case. And if that happens, then having a bond that pays, I mean, in a deflationary world, having a bond paying any interest rate, would be a good thing. But again, that's in a massively deflationary world. And I think, I think the Fed is definitely going to move to counter that. Now, okay, here's the next, then your next question should be, okay, well, if the Fed moves to counter it, will their move to counter it actually work? Or will the forces just be too damn powerful? We just keep deflating and kind of everyone goes bankrupt. And, that's one of my cases. I mean, I'm not saying it's a high probability, but it's not a zero probability. I mean, in 1929, the Fed, they say they didn't print enough money. They printed a ton of money. It didn't work. And so, it's possible that they, okay, fine, things start to collapse. They start to unwind. The Fed starts to ease. The Fed caps the yield curve, blah, blah, blah. But, just I mean, as we all, in macro 101, we all learned about the money multiplier. We all learned about, credit and how credit gets created and fractional reserve lending and so on and so forth. And it feels great on the way up because the price of everything just keeps going up and up and up and up. But on the flip side of that, it doesn't feel so good because there's liquidation. And, I mean, there's the reason prices keep going down is not because people want to sell assets that are falling in value. It's because they have to sell assets that are falling in value because they need to eat. And so they sell what they can, not what they want to. And of course, that selling begets more selling, and so on and so forth. So, the Fed has run just an extraordinarily irresponsible monetary experiment. And as a result of that experiment, we all are like, lab mice or rats in a test. And how it's going to unfold, it's quite difficult. No matter how smart you are, it's still quite difficult to know. But the way we look at it is we try and handicap all the possible outcomes and look at the potential tail events, and what investments we would want if those tail events became the likely event. So yeah, I mean, it's entirely possible that bonds will actually turn into a good investment, but that would only be the case if we had an outright deflationary collapse. So
And I guess the one thing that the Fed has going for them, that there's not really any other country that's in a in a much better position. So maybe it's just
no,
that the
no,
US
we're
dollar,
all,
yeah.
yeah, the dollar is better than all the other currencies, but there's a lot of stuff going on there too. I mean, there's a lot of, when we grabbed the Russian, reserves, that was a bad move on our part. It told the world, gee, I don't want to have dollars. And there's a lot of commerce now being done outside of the dollar. And that's not good because, demand for the dollar was one of the reasons why we had great purchasing power and we could live the way we live. And if suddenly people lose confidence in the dollar, that's not going to be a good thing for Americans and their cost of living. It's not really going to be a good thing for the world, but frankly, I think that is what's happening. I think people are slowly but surely losing confidence in the dollar, losing confidence in the monetary authorities. I mean, and losing confidence in Washington, D.C. I mean, we've got this hegemon, kind of government that has all the guns, and they can't seem to control their spending. And the thing that's interesting to me is that um, this is the world's reserve currency, the dollar. And yet we're behaving in a fashion that's much more akin to developing countries and third world countries. And and what we do know from pattern recognition is that when we look at those developing and third world countries and what happened when they behaved this way, they had, when debt got to debt to GDP got to be 130%, they got to the point where they couldn't afford the interest out of tax revenues, and we're not there yet, but we're getting there, and so on and so forth. Eventually they had really massive inflation and or really massive currency devaluations. I mean, this is not something new. This is not like we haven't seen this movie before. We've seen it in Argentina, we've seen it in Brazil, we've seen it in Venezuela, we saw it in Weimar Germany, we saw it in Zimbabwe, we're seeing it right now in Turkey. I mean, this is, it's very predictable. When you do what we are doing, the outcome is relatively predictable. Now, it's different and scary, and a lot of people want, have their head in their sand on it because it's the United States, the biggest country, the reserve currency. That could never happen, right? But I don't know. I mean, I look at the fact pattern and how this fact pattern is played out in other circumstances, and I think, well, I'm not sure what makes us so special that it couldn't happen to us as well. So that's kind of my view on that.
Yeah, I guess one benefit is that there's just an abundance of commodities throughout the US. So I guess there's,
Well, that's right. Now the U.S. will
yeah,
be better off than other countries. I mean, we run a trade deficit, but we actually have a lot of. I mean, you kind of look at any country. I mean, if you play the game Risk, I mean, when you're playing, you really wanted to get North America. Do you know what I mean? I mean, we've got resources, we got farmland, we got water, we got two oceans to protect us. I mean, we kind of lucked out geographically here in the United States. So.
yeah, makes sense. So from your perspective, your base case is uh basically higher for longer, and this commodity super cycle over the next 20 years, a secular shift. Is that
Well,
sort of
yeah, no, I'm not sure about the higher for longer. I
okay?
actually think that something's going to break here relatively soon. I think that the Fed is going to recognize. I think that either the stock market will break, or the U.S. regional banks will break, or the U.S. consumer will break, or or all of the above. And we'll start to see a really meaningful downturn that'll bite hard. People will start losing jobs. There'll be layoffs. And suddenly, keep having your wages keep up with inflation won't be as important as just, is my job safe, right? And then real estate will start to go down. And of course, you remember in the United States, most families' biggest asset is their home. And, it was nice when they had a 300, 400, 200, whatever the number was. They could look at it every year, oh, it's up more, and my house is worth more than it used to be. That's great. I'm richer, so to speak, nominally. And wait till that changes. Do you know what I mean? And, oh my, the neighbor, they lost their job. They had to sell their house. They had to dump it into the market. Interest rates are 8%. People couldn't afford it at that, it went down 30%. And then everybody in the neighborhood goes, oh shit, you mean my house isn't worth what I thought it was worth? And then they say, well, maybe I've got to, oh, and I've got all my money in my pension fund, my 401k, my this, that, and the other. And oh shit, that's down 30% too. So my retirement's looking, God, I got to cut back. And then, I cut back means I don't buy that new car. I don't buy, right. And then people who make the cars lay off. I mean, it's reflexive, right? It flows through the economy. So I think all of that is ahead of us. And then I think that the Fed's response to all of that, and it'll be interesting to see, when they do it, how aggressive they are, where they go with it. But the Fed's response to that is obviously, a return to monetary accommodation and, dropping the interest rates, maybe doing yield curve control and buying bonds. I mean, whatever it takes to kind of try to keep the economy going, because, there'll probably still be inflation, but people won't be screaming as loud about that as they'll be screaming about, hey, you idiots, this economy is imploding. What are you going to do about it, right? And so, no, I don't think higher for longer. And what's the timing on that? I mean, I would see it. I mean, I don't think we have to wait a year. I think that happens in the next year. I think this next year is going to be very, very interesting. The problems are going to kind of surface. They've already surfaced, by the way. I mean, Silicon Valley Bank was, and its failure. I mean, that was an example of the underlying problem, right? And they patched that up. But, by the way, I mean, the math I've seen suggests that maybe half of the regional banks in the United States have negative equity if you really mark their real estate portfolios to market. I mean, can you imagine half the regional banks in the United States failing? I mean, that's the 1930s. I mean, that's the Great Depression. Now, I'm not saying they will, and I'm sure the Fed will figure out some way to bail them out too. But the point is that, we're talking about a big issue here that I think is going to raise its head in the next year.
Do you see a catalyst for this, or is it just everything that we've talked about during this conversation?
Just kind of, I think it's just, I think it's going to be drip, drip, drip. I mean, at some point, something could break. I mean, at some point in time, Bank of America could fail, or, some big hedge fund could blow up. I mean, there could be something like, the Bear Stearns failure in 2007. I mean, all of, the derivatives, somebody could be mismatched. I mean, there'd be another Silicon Valley Bank. All of those things are possible. But those are all kind of black swanny. You don't really know, when they're going to happen, what's going to happen. A war could break out and, really get serious. That oil goes to 150. That would be another one. But I forget all that. Let's assume none of that happens. But all those things are possible. I think more importantly, what could happen, or what's more likely to happen, is you're just going to continually get this drip, drip, drip where, oh, like yesterday, I woke up, Walmart misses and the stock's down 8% pre-market. Well, Walmart's one of the biggest retailers in the United States, right? I mean, you want an indicator of how the U.S. economy is doing, go look at Walmart's performance, right? And if Walmart's missing numbers, guess what? The U.S. economy is slowing down, absolutely positively. And so, and then there'll be another one, and then another one, and then another one. And so I think we, it might be just kind of a water drip. I mean, eventually that drip, drip, drip might get to be a real, faucet turned on hard. And it's like, holy shit, this economy is going down fast. But right now, what I see are just kind of the dripping faucets, like Walmart missing the numbers, and I don't see a crisis, imminently, but everything is so highly leveraged. That's the other thing I think that people need to focus on today versus prior lives or prior days. I mean, we're at 130% debt to GDP right now. That's huge. That's really huge. I mean, the last time we were at this level was in World War II, and that was we were there to fight the Axis and win the war, and then they had to do yield curve control after the war to get us out of it. And the inflation, by the way, after the war was massive, just massive. So, what it informs me of is, as an investor, I think the easiest wind at your back macro trend right now is monetary debasement and inflation. And so you can figure out how to express a view on that. There are lots of ways. You can buy any commodities company, you can buy gold, you can buy silver, you can buy Bitcoin. Tavi Costa just tweeted a chart out a few days ago that showed how cheap the Brazilian stock market was. Well, turns out Brazil is a huge producer of commodities. And if we have a commodity bull market, Brazil is going to do very well. So, yeah, it's there are ways to anticipate what's coming and then to benefit from it, because I don't think a vast majority of the world understands this issue. I think some do, but I still think it's a minority. But before this is all over, by the way, I think everybody's going to understand it. Everybody's going to be like, holy shit, those currencies really got devalued. This inflation was really out of control, and we have to do a reset.
Yeah, no, that it unfortunately seems like that's the way we're going. So you've mentioned commodities, and I'm assuming that's industrial, energy, precious metals. It's all these commodities that you think will benefit. Are there any other assets do you think will sort of protect you from this monetary debasement?
No, I mean, I think, look, real estate, people often ask me about real estate. I mean, to me, as I said earlier, the biggest macro trend going on right now is that the governments are going to print to keep their broken system going because it benefits them. Okay, full stop. So what do you want to do? You want to own assets that the government can't print, because if they can print more of them, they're going to dilute the value of each individual unit. And so, obviously Bitcoin, gold, silver, they fall into that bucket, but real estate does too. And stocks do to an extent. I mean, the stocks represent a claim on the earnings of a business. And if there's a lot of inflation, the business will just raise its prices. So they'll still have earnings, they'll still be a business. Not all businesses get affected the same way by inflation, but in general, in a balanced market, if you've got a business dealing with inflation, you pass on the costs or pass on the prices, higher costs, but your margins are maintained. So to me, kind of, equities, real estate, gold, silver, Bitcoin are the obvious choices where I think people need to have some representation. Of those three, of all those, to me, the biggest no-brainer with the most upside is Bitcoin. And the reason for that is there's no management team, so to speak. There's a bunch of core developers and nodes and, so forth. I mean, and it's an algorithm that just runs. It's run successfully for 15 years, 800,000 plus blocks. And so, and it's got just enormous asymmetric upside. I mean, it's got upside just because there are a limited number of them and it's a sound money alternative. So it has upside for that. But, it also has enormous upside as adoption grows. Because right now, I don't know, it's hard to estimate, but I'd say maybe 10% of the world kind of holds some Bitcoin or knows about it. Probably maybe even less. I don't know. But the point is, I think before this is all done, before we do this monetary reset, the people who own Bitcoin are going to own a lot. There's going to be a lot more people owning it, and then the price per coin is going to be a lot higher.
That's interesting. And are you concerned? Because I guess Bitcoin generally correlates with the NASDAQ. Do you think that it's going to continue, or would you say there's going to be
no? I mean, you're right. It's a great question. And yes, the answer is yes. I am concerned. It has been the history so far. It's been like a risk-on kind of asset. I think the two are going to kind of separate over time. It's a very volatile asset, and it's driven by liquidity flows. It's probably, we've often said it's the loudest fire alarm about monetary debasement. Louder than gold. And monetary debasement takes liquidity flows to push it up. So yes, it has correlated with NASDAQ, but I think that correlation is going to fade and break down over time. Maybe not completely, because NASDAQ, the good companies in NASDAQ are very high profit margin companies with very strong moats and long duration lives. I mean, you look at it like a Google, it's a thing of beauty, right? And so, Bitcoin is a similar kind of thing, but more just a stock to flow monetary unit, not an application like Google. So, but so I think there will always be some correlation, but I could easily see a scenario where NASDAQ underperforms Bitcoin pretty substantially, because I think NASDAQ is pretty widely known and pretty fully adopted. And I think Bitcoin is still really early on that adoption curve. And so we've got a big ramp to go. I mean, the Malcolm Gladwell theory of tipping points, where when something gets to kind of the 10% awareness level, it rapidly climbs the curve to be at 90%, you know, in the same time it took to get from 0 to 10. And this applies, you know, it's applied to cars and cell phones and computers and I mean, all of it. See this pattern over and over and over again. And I don't know where we are exactly, but, you know, 10% kind of sounds right to me, maybe a little lower than 10%, you know, of the world owns and is aware of Bitcoin today. Or maybe I should say of the Western developed world. I mean, you know, people in poverty are obviously not aware of it. And so, you know, at some point it's going to become obvious and the tipping point will have been reached where, you know, we'll get into really solid growth in the price of Bitcoin because there'll be a lot of new people coming into it and a fixed supply, right?
Yeah, it's a good point. So if we look at the so a few years ago, when the futures ETF was approved, it was almost used as a way for institutions to short Bitcoin. So do you see that something potentially happening as well with the spot ETF that is looking?
I do. I mean, I don't, you know, I mean, when the GLD ETF came in, you know, the interest in gold went up substantially and that ETF grew really, really quickly. But it also, you know, provided a way for them to manipulate the price of gold because there were times I'm almost certain that ETF took in the money and didn't buy the gold. So that's a nice way of siphoning off capital that wants to buy Bitcoin and not actually affecting the market, right? You know, it's what I call paper Bitcoin or paper gold. If I buy a Bitcoin from you, I send you $36,000 and you say, hey, Larry, you know, you bought a Bitcoin from me and I got it for you. You can come get it when you want, maybe. You know, and then you never go into the market and actually buy the coin. All you've done is made a contract with me to give me a coin at some point in the future. That's paper Bitcoin. So my 36,000 that I gave you should have gone into buying a coin and making the supply and demand picture more accurate. And yeah, I mean, BlackRock is notorious for, you know, kind of rehypothecating things and doing all kinds of funny stuff. That's what Wall Street does. It levers things up to you know, extract a tiny yield out of them. But, you know, we like to say it's like picking up steamroller or nickels in front of a steamroller. I mean, you know, the fact is there are 21 million Bitcoin. They're all on chain. We can see them. And the gold market was much more opaque and much more easy to and subject to this kind of manipulation than the Bitcoin market. You know, and you can see where all the coins are now. I'm guessing this, you know, in the case I mentioned, I mean, a lot of people aren't going to publish their addresses, but the point is they could, and there's a way to forensically look at who's buying what, where, when, and so that makes it a little bit different than gold, but it's a risk for sure. It's definitely a risk. I would say this. I think it's on the radar screens of all the central banks. They're very concerned about it, but I also think they kind of know they can't stop it, and that's why they're continuing the propaganda that they're continuing to kind of just knock it down and pay people to knock it down, which I'm pretty sure they're doing.
Yeah, no, great point. So, Lawrence, thanks so much for coming on the podcast today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
I think the message I would say to everybody is if you're looking at your savings and your investment portfolio, you need to ask yourself, what have I got in here that accounts for quote unquote monetary debasement? You know, I mean, and stocks, and you know, so bonds definitely don't qualify. Stocks kind of qualify, but they're not ideal. Bitcoin, gold, and silver definitely qualify. Real estate qualifies, and I would also say, one other thing. I think there are some people who have zero Bitcoin, and I've never seen a more asymmetric bet than Bitcoin. I think the upside here is enormous, and it's going to go up 10x, 100x, 1000x. And so, you know, if that happens and you know about it now, you hear about it, and that happens, you're going to have regret in 5 or 10 years. Holy shit! Somebody told me about this thing when it was 35 grand, and now these coins are worth $2 million a piece. What was I thinking? You know, so I would suggest to everybody that you get a little bit. You know, it doesn't have to. You don't have to. I mean, it's volatile. You don't have to bet the whole farm on it. But when I talk to potential clients or clients in my fund and otherwise, I always just say, you know, you just can't. You can't have zero Bitcoin. We just don't know what's going to happen. But that upside optionality is large enough that you're nuts if you have zero. You're really missing something on the diversification scale.
Great point. So, yeah, Lawrence, thanks again for your time. I appreciate it. If anyone wanted to find out more about your work, what you do,
yeah, so absolutely. If you don't mind, I'll make a little shameless plug here. So I'm on Twitter at Lawrence Lepard. I basically just yell at the central banks. I think they've done us all wrong. I'm very angry at how much they've screwed up the world. So you can tolerate my anger. That's a good place to, and I do a lot of macro stuff there too. I have a website, EMA2, EdwardMarkAlpha2.com, where we publish a quarterly letter that talks about all these issues we've been discussing. It's free. You sign up for it. We won't spam you. And then, of course, I run a fund that invests in these sound money assets. And we actually have some open slots now. We don't always have open slots. We do now. You have to be an accredited investor, and the minimum is $100,000. So shameless plug, but anyone who's interested in investing in the fund, you could reach out to us.
I think I'll put that in the description below, but thanks again for your time.
Oh, thank you so much. I enjoyed it. We'll do it again soon.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.